So this is, again, for the loan associate on what we call the mining process. So this is when you have new opportunities. Um, what form will you use to try to screen the individual and log the information to see if there's going to be a fit? Because remember, you're in the business of disqualification more than you are qualification, and so this form will help you vet some things out. So once you have a new inquiry, you're talking to the borrower um, directly and getting some of the information, this is what you'll do. So the first thing is the file name. So you'll see here is what is the name of the file. This should be the name of the property or property address followed by either refinance, purchase, or new construction. So again, that's how you're going to name this thing. And then you'll put who's it referred by. Again, this will go in the database and eventually will be in there, but this is important to note. The date of the app, this is the date you received the request, okay? So you'll log that here. Sponsor contact. So again, this is the who's actually borrowing the money. This should be either A, you pull from the existing database, or have the ability to be a new contact, okay? So you'll log their name here. If they're already in the database, you'll put SD, so you see database, SD if they're in the database here. You'll put the property address here, the physical location of the asset that we're financing. If it's a business acquisition, just their primary location. Here you'll put the loan request. So again, the loan amount that they're requesting. What type of asset it is, apartment, office, retail, owner-occupied, etc. Then we're going to get into some where we're starting to really screen. So we call these the mining. So you're trying to mine through information to see if there's a fit. So urgency we define as all these must also have them getting us information within a week or less. We kind of talked about that. So urgency are things like this. Are they purchasing a property? If so, are they under contract? Is it out for signature? Is there a 1031 exchange? Are they not under contract? So we want to know, have they taken the steps to move forward, which shows urgency? If it's a refinance, is there a balloon in 6 months or less? Is there a major rate discrepancy with time parameters? Is there a major cash need personally or business? Or is there just no urgency at all? Development, is there a major timeline challenges? Is there cash needed with urgency or is there no urgency at all? You're trying to discern through if this is something that is a nice to versus a have to. And we're really looking for have tos, because that really breeds motivation. So urgency is the first one you're trying to identify. The second one is loyalty. We define loyalty as such. So they're not working with anyone else and agree to work with us, or, that's one option, they are working with another bank in verbal agreement of how we can win it. Okay, so that you've clarified that. 3, they're working with another broker and agreed to sharing a list of lenders so that you can know if you can beat it. Number 4, there are no options for loyalty with the client, okay? So, et cetera, et cetera. So there just may not be. If we can't get loyalty, it's probably a deal killer, and we'll contact the manager to determine whether to proceed or not, all right? So that's the second thing of trying to determine whether this is something we can work with or not. The third one is cash flow. So in this section, we're trying to determine if the project will meet the cash flow needs to qualify. If it's a conventional owner-occupied investment, we need to have a 1.2 to 1.25 debt service coverage ratio. What that means is, the full fiscal year's net cash flow is determined by adding the net income, add back interest expense, add back rent if they're going to replace it, add back depreciation on their tax returns. It all has to be on their tax returns. And you get to a net cash flow. Whatever that loan amount and the loan payment is going to be for the year, you're going to divide the cash flow by the debt payment. So, for example, if a company has $125,000 a year of cash flow for 2020, and then their loan payment is $100,000 a year, you take the 125,000 divided by the 100, and that gives you 1.25. If you get below 120, it's tough. It makes it more difficult because they want to see there's cushion, 20 to 25% cushion between the payment and the cash flow. If it's a projection-based deal, it's 1.25 in the future, and they're looking for outside cash flow of 1 to 1.25. So, for example, if it's a startup and let's say someone still has a job or a husband and wife, then their income could be sufficient to where they could still service the debt with the outside income for the new loan. And you're going to do the same thing, determining their cash flow. And by the way, the cash flow is going to be before all of the debts, and then you're going to divide it by all of the debts that they have. That'll be a different discussion. Private money, that's just the ability to take the loan out. So there's not necessarily cash flow, but it's more collateral driven. So once you've collected from the checklist below and have run the numbers to determine if it's a pass or not, there is nothing to put in the field or a pass or a fail. So what you'll do is you'll probably have a verbal discussion about their numbers. If they don't know them, you need to get the information, but this is critical because if it doesn't have the cash flow, then it's a dead deal. Okay, and then you'll rate them down here. So is it a 1 is a pass, 0 is a fail, same thing on every one. The fourth section is credit. So when we talk about credit, we talk about we need to know the client's credit situation, which is anything in the last 8 years. So this is late pays on mortgages, bankruptcies, foreclosures, short sales, lawsuits, now or in the past, something else, etc. If it's none, it is an automatic pass. If they choose one or multiple, then we need an explanation. So there's a little bit of gray here, but you need to know. They'll have to submit it to a manager to determine this. But what you're trying to figure out is if it was recent, then we definitely need to have a deeper discussion and maybe an explanation as to what happened. And again, you'll rate it down here. Collateral. What we mean by that is determining if they have sufficient collateral for the loan we're obtaining. If it's a real estate investment non-recourse loan, it has to be 65% or lower, honestly. If it's apartment, 75% is fine, loan to value. If it's a triple net property, single tenant, 55 to 65 loan to value is sufficient. Real estate investment recourse must be 70 to 75% loan to value. Real estate investment new construction must be 65% pre-leased. And you can borrow about 70 to 75% loan to cost. Real estate investment, new construction spec, meaning it's speculative. You really have to have a super strong guarantor with outside cash flow, and they'll have to be 60% loan to cost. Owner-occupied SBA conventional must be 90%, it'll be 90% loan to value. Owner-occupied SBA non-conventional, which is special purpose or mediocre deal, is 80 to 85%. Owner-occupied conventional must be 75 to 80% loan to value. And then business acquisition, consolidation, some coverage depends on, and you'll need to talk to the manager. There's actually a whole section on vetting deals that we'll talk about that will teach you and train you on how to actually have the discernment of like what's a good deal, what's a bad deal. But that's important, and then you'll rate it. Credibility, we're talking about the borrower's ability to have experience. So 1, have they worked in the business for 1 year or more? Have they worked in a like-kind business for 1 year or more? Is partnering or hiring someone who has 1 year or more in this industry. So we want to really see if they have the credentials or like kind experience. And if there's a gray area, obviously we want to ask your manager, and then you'll rate it. Fee discussion, again, like I said, 10,000, usually 7,500 or higher. 10,000 is better, obviously, but we want to make sure that you have that discussion up front. Hey, we charge 1% or 7,500. Make sure that that falls in line here, and that they're on the understanding before we proceed. And then you a one or a fail. Credit expectations. What are they expecting from a timing perspective? If it's private money, 2 weeks or greater, yes. If it's bridge lending, 30 days or greater, yes. If it's conventional, I would even say 60 days or greater right now, yes. SBA, same thing. And you can refer to the deal model, which we'll again talk about, to see if you're in alignment or not. But you need to see if they're aligned with reality of the market. If they're not, it's probably a fail. Hurdles. Again, this is just, are there any other hurdles, issues you see on the loan that we're not aware of? This will take you a little time to learn, but you know, we just want to make sure that you're keeping a good tab, and then you want to rate that as well. Asset description, you want to know for properties, square footage, amount of units, if applicable, the land size, how many buildings, the condition of the asset, if it's individually or master metered for apartments, parking ratios, what's the unit mix if it's apartment or self-storage. There's a lot more things obviously we'll talk about as well, but this just gives you an idea. We want information. Ownership structure, is it going to be an LLC or taking title individually? What's the ownership percentages of partners? Who has control? It's important to understand if there's partners, the more people, cooks in the kitchen, the more difficult it's going to get. So just remember that. Value of the collateral, what do we think it's worth? What do they think it's worth? Do they have an old appraisal? Can they get you comps? That'll be really a huge deal to make sure our loan to values are correct. History of the deal, we just want to know like what happened. What's the history of the transaction? What have they done so far? Has there been improvements? Have they gotten approvals through the city if it's construction? Gone through a neighborhood hearing if there's special documentation? We just want to hear what happened, what was the history of the deal, so we can better explain it. If they own it already, you want to know, are you thinking about selling anytime soon? Reason why this is important, because I can tell you it causes problems. We've had people sell while we're in the middle of a transaction. So we just want to make sure this doesn't hinder the process. And then what other deals are you working on? It's a great question to ask if you're trying to get more deals. Just really focus on that. And then if there's any additional notes. So this is the mining process. I'm telling you right now, this is probably one of the most important things you'll do that will save you a lot of time and headache. If you bypass this, you're gonna have a lot of problems. So just make sure you really stick with our process so you can have success.